Looking at the Markets with David Modell. Hello and welcome to Looking at the Markets with David Modell. I am so excited about where gold is going. I think it's going much higher. And if you are interested in gold as an inflation hedge and a growth investment, you're going to want to watch this entire video. With me today is Mr. David Garofalo, Chairman and CEO of Gold Royalty Corp. Welcome to the program, sir.
Thanks for having me on, David.
Absolutely. And if people want to learn more about Gold Royalty Corp, you're going to want to go to goldroyalty.com. Link is in the description below this video. The ticker on the NYSE American Exchange is GROY. Now, Mr. Garofalo, you've warned that gold is depleting and this is a real problem. How bad could it get and how can investors respond to this?
Yeah, it is quite acute. We've seen a 40% decline in gold reserves over the last seven years because the established producers have not been reinvesting meaningfully into exploration and development to replace their depleting reserves. And so we are going to see significant supply shortages, particularly when you consider the lead time to new production is a minimum of 10 to 20 years. So even if there were a significant discovery tomorrow, and there hasn't been, we're not going to see the evidence of that in the production profiles for at least a decade, if not more. And so we're going to see a pronounced downward trajectory in production for the foreseeable future. So the mining companies really aren't equipped to deal with the significant surge in demand, investment demand that we've seen on the gold side. And what's driving that investment demand has been low interest rates, negative real rates, negative nominal rates, significant amounts of quantitative easing across the globe. It's been a coordinated effort by central banks. And so there is significant investment demand in gold, but there isn't the supply to meet that investment demand. So we're going to see appreciably higher gold prices. And the way to play it, I think, are severalfold. You can obviously buy the producers and get leverage to the gold price and leverage to any exploration success and production success and profitability. You can buy the ETF, GLD on the New York Stock Exchange, which is a physically backed piece of paper, backed by physical gold. Or you can buy the royalty companies, which I think is the best of all worlds because it provides you that leverage to the gold price, that top line exposure, revenue exposure, but insulates you from the underlying operating risk, capital cost risk that producers have inherently in their profile. So it's leverage to gold. The gold price leverage to exploration success without the underlying risk of running operations that the producers provide.
It's a great way to play the gold supercycle as I see it. Now, in your opinion, why are central banks steering away from the US dollar and moving towards gold?
Well, because there's a lack of confidence in fiat currencies. What's happening is a competitive devaluation of currencies around the world in order to preserve export markets. All the central banks are doing the same thing. So if you're running a central bank, the only true currency, the one that can't be quantitatively eased, can't be printed, is gold. There's a very finite amount of gold on the Earth's surface. In fact, it's only 200,000 metric tons that's been mined since the beginning of time. And quantitatively, or volumetrically, it's very, very small. You could fit it in 4 Olympic-sized swimming pools. So you can imagine any significant amounts of capital that's allocated towards physical gold will have a very pronounced impact on the gold price. And we're not even close to the cyclical high on gold. If you look at gold's all-time peak, in real terms, it was back in 1981 when it was $850 an ounce in 1981 dollars. Translated into 2021 dollars, that's $3,000 an ounce plus. So we have a long way to go even to achieve cyclical highs. But I would argue that the debasement of currencies we're seeing now is much more pronounced than it was in the 70s and 80s when we had hyperinflation. Because back then, the central banks weren't coordinating their efforts. They weren't competitively debasing their currencies. Now they're actually acting in concert to do that. And that really started back in the credit crisis about a dozen years ago, where they started to coordinate their efforts. And now they're doing that much more efficiently. And what that's done is driven up supply of paper currencies dramatically across the world.
What role will junior gold miners play as gold reserves get depleted?
Well, what they're doing is providing exploration, grassroots exploration. I would say the junior miners do that much more efficiently and do it with much more success than the established producers. Established producers, their job is to mitigate risk. They're looking to maintain safety, maintain cost efficiency, avoiding risk. The juniors embrace risk. They're swinging for the fences when they're putting a hole into the ground. They're looking for the next big discovery. And so they're designed to embrace risk. They're much more entrepreneurial in nature. So they really provide a source of grassroots exploration for the established producers who, by and large, have outsourced that to the juniors. And so the established producers need the juniors to be successful. They need the juniors to be able to access capital. And we're seeing that they're able to do that, at least selectively now, in this higher gold price environment. 2 years ago, they couldn't raise money to save their lives, but now they can, at least for high quality projects, they can raise capital. And the established producers desperately need these juniors to provide that source of pipeline opportunities that the established producers really are not set up to do.
Now, as the name suggests, Gold Royalty Corp uses a royalty business model in which you would provide financing for gold companies in return for a percentage of gold production or revenues. What are the advantages of the royalty business model?
Well, there's several fold. I mean, for the producers and for the junior explorers who can't raise capital, we provide a much lower cost of capital source of cash to fund their exploration and development stage activities. And we take a royalty back, effectively a percentage of the revenue back, in return for providing that financing up front, that risk capital they need to do the exploration and development of their projects. But from an investor standpoint, why buy a royalty vehicle, as they say, as opposed to buying an established producer, or for that matter, buying the physical gold? Well, if you buy the physical gold, the GLT on the New York Stock Exchange, for example, you do get an ounce of gold or an eighth of an ounce of gold to back each of those shares. So you get that physical exposure, that leverage to the gold price. When you buy an established producer, you're getting that, plus you're getting leverage to the exploration upside, leverage and profitability as they mine those ounces. But you're also getting exposure to the underlying risk, geopolitical risk, exploration risk, capital expenditure risk, operating cost risk. When you buy these established producers with a royalty vehicle like Gold Royalty, you're getting the best of all worlds. You're getting that top line exposure, you're getting leverage to the gold price, but you're also getting leverage to the exploration success. So as our operating partners grow their reserves through their exploration efforts, we get full participation in that. But what we don't have is exposure to the operating risks and capital cost expenditure risk, the inflation in those costs. And believe me, we will see significant cost inflation in the mining sector. We've been largely insulated from that over the last 5 or 6 years. But with all this quantitative easing, we've seen a significant rally in both base and precious metals. We're going to start to see significant capital and operating cost expenditure inflation. And the royalty companies provide you insulation from that because they only have that top line exposure.
Now, at the executive level, Gold Royalty Corp has some well-known names, besides yourself, in the gold sector. Can you elaborate on just a few of those?
Yeah, certainly. I bring over 30 years of experience running both Gold Corp, most recently, and before that, Hudbay Minerals on the base metal side. And before that, I spent 12 years with Agnico Eagle as the CFO during its formative years. And so I come from an operating background where I've actually been involved in the development of over 15 different mines over my 30-year career. Also, within my group, I have Alistair Still, who's our Director of Technical Services, and is also the CEO of our parent company, Gold Mining Inc. And Alistair brings a wealth of experience as a senior operator in our Canadian business at Gold Corp, and we worked there together. He built our Cerro Negro mine in Argentina, so it has development experience as well, and also was head of our corporate development activities for our Canadian business at Gold Corp. So he has both capital markets expertise and a strong technical foundation that he brings to the company. In addition, on our board, we have Alan Hare, who's the Chief Executive Officer of Hudbay. After I left, who was my Chief Operating Officer, and over 35 years as a metallurgical engineer, is a prolific mine builder. Warren Gilman, who runs Queens Road Capital out of Hong Kong, which is Li Ka-shing's natural resource fund. He's on our board, and also is a cornerstone shareholder of the company and brings over 30 years of experience as an investment banker in the mining side with CIBC before he joined Li Ka-shing's group. And in addition, we have John Griffith, who's our Chief Development Officer, most recently was the head of the North American mining practice for Bank of America Merrill Lynch. And so he brings a wealth of transactional experience. So I would say the recurring theme in our board is we actually come at it from an operational perspective. Many of us have been operators, mine builders, mine developers, and mine operators, which gives us a clear-eyed view of the underlying risks of the projects that we're investing in, but also gives us unparalleled access to all the major operators in the world as we look for royalty opportunities. We have a very deep Rolodex that we can leverage. And then finally, the last person I should mention is Ian Telfer, who's the chair of our advisory committee. And Ian is also a cornerstone investor in Gold Royalty. He's also the person that pioneered the whole royalty and streaming model with the creation of Wheaton Precious Metals over 15 years ago, which he spun out of Gold Corp to create Wheaton Precious Metals, which is one of the largest by market cap royalty and streaming companies in the world. And he pursued exactly the same model to create that vehicle that we're pursuing with Gold Royalty, in that we spun it out of gold mining with a significant foundational element of reserves and resources, over 26 million ounces of gold reserves and resources within our royalty portfolio that we inherited from the spin out of gold mining, or from gold mining. He did exactly the same thing back 15 years ago in creating Wheaton Precious Metals with a collection of royalties on Goldcorp's operating portfolio. So it's a very similar model, and we're just essentially replicating that with a very high quality foundational element of reserve and resources that we've inherited from gold mining.
Yeah. I like it when insiders and institutional investors have confidence in a gold company. Can you provide some of the details on the shareholder profile of Gold Royalty Corp stock?
Well, 48% of it is still owned by Gold Mining Inc., who again spun out the royalties from their existing portfolio. Gold Mining Inc. is a publicly traded company on both Toronto and New York stock exchanges. And they're a long-term investor. They're obviously going to be there for the duration as we start to diversify our portfolio beyond the 17 royalties we inherited from gold mining. And beyond that, we have, in terms of the rest of our shareholder base, 60% institutional, quite broadly disseminated. We had a very successful IPO about 2 months ago that raised $90 million US and afforded us a $200 million US post IPO, post money valuation. That gives us currency and it gives us cash so that we can start to put that capital to work in new royalty opportunities as we look to diversify beyond the 18 royalties we already have in the portfolio.
I also understand that Gold Royalty Corp's portfolio is highly diversified geographically across North and South America. I know this is a big question, but can you distill down a few of the most prospective projects and where they're located?
Yeah, for certain. We have the Whistler project in Alaska, which is the significant gold resource, but also has a significant copper resource. And as many of you know, copper is one of the hottest commodities in the world right now. It's actually integral to the decarbonization of the global economy. Copper is super important in building up power grids, in building electric vehicles as we start to transition away from internal combustion engines. Typically, an electric vehicle uses 3 times the amount of copper that a traditional internal combustion car uses. So we have 2 billion pounds of copper reserve and resource within that portfolio that we inherited from gold mining, upon which we have royalties across the board. We have a number of projects in Latin America as well, but collectively we have over 26 million ounces of gold reserve and resource within that portfolio, and over 31 million ounces on a gold equivalent basis when you consider the significant amounts of primarily copper byproduct that we have within that portfolio.
Very nice. And finally, Gold Royalty Corp is very well capitalized, especially when compared to the company's peer group. Can you tell us about Gold Royalty Corp's balance sheet and cash position?
Well, we have no debt. We have a very clean capital structure. We have $90 million US of cash on the balance sheet. So we have plenty of financial firepower to put to work and to new royalty opportunities as we look to diversify the portfolio. We will be very active and transactional, and we will be acquiring royalties and growing the business, we think, quite prolifically over the next year or two as we put that capital to work. So I have a lot of confidence in our investment model, but I also have a lot of confidence in the experience and expertise of our management board to open up opportunities for us to acquire royalties at very high rates of return.
Once again, goldroyalty.com. You got to visit the website to get the full picture. Check out the investor presentation and check out the star-studded, I would say, who's who of people on the executive and management teams at Gold Royalty Corp. It's really something. Decades of collective experience in finance and the commodities space. The ticker symbol, there's only one, NYSE American. It is GROY. This can fit into, I believe, any portfolio. You really need to get some gold exposure now. Why not do it through the royalty model and with a company that is really leading the way with so much experience, no debt, so much cash on hand, a geographically diversified portfolio. There's so much to like about this. Mr. David Garofalo, Chairman and CEO of Gold Royalty Corp. We're going to have you back soon when gold is much higher, $3,000 and higher, I believe, and we'll get an update from you, hopefully. Thank you, sir, for coming on to Looking at the Markets.
Thank you, David.